Hello there. Welcome to Commodities. Let's see how that old energy complex is doing right now. Now, the Russians have resumed loadings at a Russian export hub, which was briefly paralyzed by a Ukrainian drone and missile strike. You would think that that would be bearish for oil, easing the flow of Russian crude onto the world market, but crude holding its own today. And there's a look at oil over the past year. It's been a miserable story. Miners are happy, of course, it brings down their diesel costs, and that's a significant item for giant mines. Let's have a look, speaking of which, at the metals. Now, gold got to that record high of almost $4,400 US an ounce last month. Since then, we've seen some strengthening in the US dollar. That always tends to bring gold down, simply because that commodity is denominated in the US currency. Goldman Sachs reckons this weakness in gold lately is just a blip. And it is forecasting that gold prices will hit 4,900 by the end of 2026. That would be a gain of about 21% from the level today. Lena Thomas, though, apparently not calling for $5,000 gold. I mean, I'm sure she's not ruling it out. She reckons, though, that investors, particularly private investors, have been diversifying into gold. And if that were to gain more traction, people buying gold to hedge against risk in their stock and bond portfolio, that's going to bring us off to the races again. OK, let's have a look at Teck Resources. The industry minister, Melanie Joly, is talking tough on Anglo-American's pledges related to its planned takeover of Teck, once again saying it's not enough, adding that Canada should get more out of the deal. Of course, Ottawa wants to maintain homegrown global companies with big Canadian HQs. She's aiming to deliver a decision before too long on whether Anglo can proceed with its takeover of Teck. The Globe and Mail's Niall McGee reported this morning that a sticking point is now Ottawa's insistence that Anglo move its actual domicile, the actual place where the company is officially based, not just the head office, to Canada, and move its primary stock listing to Toronto. And apparently the company has been pushing back on that. China has significantly accelerated purchases of American soybeans. It had halted them for some months in the trade standoff between the two nations. The U.S. Department of Agriculture says the Chinese will buy almost 800,000 tons of soybeans for the 2025-2026 marketing year. That would be the biggest daily purchase in 2 years. Soybean farmers are now more optimistic that they're going to end this standoff, which has been very tough on the U.S. sector because China is a huge customer for soybeans. Of course, the likes of Argentina and Brazil, all too happy to step in and supplant the Americans in that market. And the European Union is planning measures to limit outflows of aluminum scrap. The European Commission says the steps will allow industries using aluminum to access adequate qualities of the material. U.S. President Donald Trump has doubled U.S. tariffs on aluminum imports to 50%, with the exemption for scrap metal. OK, let's stick with base metals. The TSX index of base metal stocks is up something like 26% this year. There's lots of interest in copper and nickel as ways to play an electricity-focused world economy. The head of Vale's base metals unit is aiming to get the operation ready for a potential initial public offering by 2027. We're joined by Sean Osmar. Thanks very much indeed. Great to see you again.
It's good to see you too.
I know nothing is certain. You might just do a spin-off to shareholders. It's been a work in progress, but an IPO is still possible as well.
I joined because of that possibility. I think it's an underappreciated, unique platform, which has huge potential that the market cannot see. So if we can get the Canadian base, the growth potential in Brazil and elsewhere on this sort of vertically integrated global platform in a moment of critical minerals need up to speed for the market to see that, we then have the opportunity to capture the cost of capital arbitrage between a diversified like Vale and indeed what a pure play would be. So I think it's an interesting possibility. It'll be up to our shareholders, and I'm speeding along to get us to that point.
I think we have a chart showing that Vale's profit essentially comes from iron ore.
Yes.
Right now, nickel
Yeah.
and copper are really not a very big contributor. So obviously your thesis would partly be there. It's just buried within Vale. People can't really see the value.
When I first looked at this, I looked at it, I mean, Sudbury needs no introduction. It's been around since 1886. I think it's the original critical minerals Canadian story, actually. We're in Voisey's Bay, you know, we've got Thompson, we've got Long Harbour, we employ 7,200 Canadians. We gave, I think it was 95% of all the high purity nickel in World War II. So this has been a large part of this thematic.
We have a map. It's a little hard to make out, but of course, sorry to interrupt you there. No. Sudbury in Ontario, Voisey's Bay in Labrador, and still the operation in Manitoba. Carry on, Sean.
So the idea is at a time where the Chinese are dominating supply and the world actually needs us starting to pay attention to its supply chains. We do 60% of the high purity nickel into aerospace and defense. Last year, exactly, and we have for over 100 years done this reliably. So it's underappreciated. So if we can actually get this into the lower half of the cost curve, all you need is a change in the cycle, because at least half the cost curve is underwater in nickel. And we're polymetallic, so in places like Sudbury, only half the revenue comes from nickel. We're investing, there's huge growth potential. And then to your point, it's to really make it visible and relevant. In copper, we are at about 350,000 tons per annum. We're looking to at least double that, mostly in Brazil, over the next decade. And it's really low capital intensity, and you know, it's not at altitude. So the idea is to do this, operate reliably, and we're doing that. It's been a remarkable change.
Because you get copper out of the giant mine at Salobo.
We have our cornerstone is Salobo, and we just recently hit some new records on that mine. It's, you know, multiple decades and still open in every direction. But we have this sort of regional opportunity in a region that we've been active for decades. So our next cab off the rank is a project called Bakaba, less than $5,000 a ton in terms of capital intensity. We'll bring that on around 2028. And then we've got a series of these sort of hub and spoke type opportunities, which have much lower capital intensity and risk than a massive greenfield. And as you know, copper's had a history of stubbing its toe every time it brings on new supply. I think this year is a case in point, about 6% below what the market was expecting at the beginning with some of the disappointments. So it's a unique opportunity. It's
interesting you mentioned altitude, because some of these projects in Chile have had problems. I don't know if it's all altitude, but it can be a tricky place engineering-wise. It's such an achievement, actually, producing copper up in the Andes.
Yeah, people are amazing. I mean, we do stuff up in the subarctic, obviously, at Voisey's, but you look at Para, we just had COP30 now. And, you know, we're in the heart of the Amazon. We protect 2 million hectares of rainforest as part of our commitments to the region. But these to have low altitude infrastructure, a dedicated workforce, and all that provision is a huge advantage.
So you've had such a career. You're South African originally, but you were a CFO of Barrick at one time. You worked at Xstrata when they swallowed Falconbridge, I believe, and then it was taken over by Glencore. And then you left to form a gold royalty company, and you got wooed back by Vale.
Yeah, I built Triple Flag from an idea in 2016 to its $9 billion market cap business with capital from Elliott. I loved it. And it was the chance to build something at a time where I felt the market it was underserved, the mining sector outside of large diversified. They didn't have the capital. And we IPO'd back in the TSX in 2021. Bizarrely, at that time, it was the largest TSX mining-related IPO in 8 years.
So Triple Flag was.
Yes, Triple Flag. And so I just think I'm proud of the team. It's gone on so well. But this moment, I think, with the critical minerals thematic and the chance to get this business to perform and then to potentially IPO and unlock this value and maybe create another North American champion, I think is a unique opportunity.
What has held back the base metals operation over the years? Because Wells Fargo say you've turned it around, or you're succeeding in turning it around. But what has been the problem?
Look, I think the first thing you'd sort of alluded to, when you look at the current performance with Vale, if you're sitting in Rio and you're allocating capital at a time where obviously base metals have very different characteristics. The one is, perhaps the premier iron ore mines in the world. They're incredible with logistics and large open pit mining operations, and they're really exceptional at it. But the marginal dollar most times is going to go into those operations. And when you think about this business, been around for centuries, mostly underground rather than open pit, mills, concentrators, smelters, refineries, all the things that the Canadian government and others are talking about, we're doing. And we're doing it from Indonesia, Japan, Wales, all over Canada and Brazil. So the real thing here is focus. And that was the idea that birthed the carve-out. So they could see it had this potential. You know, Mark Kudafani was my chairman. He'd sort of done an asset review and said, look, if you can deliver this, it's perhaps $30 or $40 billion. We had a research report just a week that came out identifying at least $30 billion of value. And as you know, the Saudis invested a couple of years ago, $2.5 billion for 10%.
In Vale-based metals.
In Vale-based metals specifically. So we know the values there and the work we're doing to sort of get the operations to reliably produce, to bring that focus, and then to really unlock the things that we can control in that endowment is, it's exciting.
So you have in Sudbury, just remind us, you refine and you have a smelter.
Yeah, we actually had Mr. Hodgson last week visiting our Copper Cliff refinery. Yeah, that's right. And you know, we have 5 mines there. We're actually investing in bringing back some of that capacity so that Sudbury and Canadian copper and nickel specifically can actually compete on a global scale. You've seen Australia go out of business. And so part of this... why did they... There's massive oversupply coming out of Indonesia. So I'll give you an example. Nickel, you know, copper is more of a supply story that continues to underperform where the sector struggles. So GDP growth, roughly 2% or so growth year on year is what the demand growth story is. We have a fundamental growth story in nickel of this year on year. I think it grew just about 7%.
For batteries? Sorry.
Well, it's stainless steel primarily and batteries. And, you know, but if you look at it, we, just in this last period, 7% demand growth year on year, 15% supply growth coming out of Indonesia. So more than half the cost curve underwater. So our focus is really to make sure that this endowment that we have in Canada is robust, doesn't go the way of a lot of the Australian and New Caledonian operations, can be globally competitive in the lower half in the cost curve, and then use that because the cycle will turn. And at that point, we'll take it forward. Now, in Sudbury's case, we, for the first time since 2016 this year, we'll do over 5 million tons through the mill and concentrator. As you appreciate, 5 mines feeding a mill and concentrator, there's fixed costs in the downstream. And the only way to make it cost competitive is to make sure that you can mine effectively, have a contribution margin that will flow through into your mills and concentrator to make it globally competitive. We're investing in that. Our teams are coming to the table. We've dramatically lowered overhead. We're reinvigorating these guys, and it's exciting.
We've only a few seconds. I got to ask you a question that I know you won't answer, but there's been speculation that Vale might step in as an interloper in the Teck takeover. Of course, you've looked at it. You'd be crazy not to, but can you give us any thoughts there?
Look, I've ignored a few journalist calls on this, as you'd imagine.
Yes.
The only thing I say is, like, the real focus for us, that comes back to your IPO point, is fundamentally the market doesn't know what we have. So the biggest disservice I could do to Vale and to Manara, our shareholders, is to not be able to actually unlock that value through this pipeline. And then we'll go and play when we got the cost of capital opportunity. Right now, I've got to deliver organically.
Sean, thanks very much indeed.
Thank you.
Sean Osmar, he heads up Vale Base Metals. Coming up, reports say Elliott Management, small world, have taken a stake in Barrick Mining. We'll be right back. Our Bloomberg reporter, our partners are reporting that Elliott Management has taken a stake in Barrick, valued at perhaps $700 million US. Let's get more from Bloomberg's Jacob Lawrence. Jacob, great story. Elliott don't mess around. They often demand changes.
Yeah, that's right. So as per our reporting earlier today, what we've heard is that Elliott has taken a pretty sizable stake in Barrick Mining. This is something that's been speculated about for some time now. Obviously, the gold mining company has been struggling over the past year, especially in the first half of the year. Its shares really struggled to keep up with the price of gold. Part of this is because of a whole bunch of operational setbacks that the company is facing. Some of it has to do with cost overruns at its assets in North America. At the same time, one of its biggest mines was seized in Mali by the government. So all these things have been holding the company back a little bit. it's garnered now the interest of Elliott, which, as we know, is a pretty aggressive activist shareholder and looks to want to shake things up at the company.
You know, one knock against Barrick, I guess, over the years has been, well, they've got geographical risk in Africa, and that was borne out in Mali. So I think there's talk of splitting North America and then Asia, Africa.
Yeah, that's right. Internally at the company, ever since the departure of their CEO, Mark Bristow, in September, the company looks to be turning the page and looking to refocus its assets or refocus its operations on its North American assets, where it has some really well-performing operations in Nevada and one in the Dominican Republic. What we've heard is that the company is looking at scenarios in which they could split itself into two, with part of the company being a standalone North American gold miner, and then the rest of the company being the rest of the international assets that Barrick owns. We've seen over the past few years now that Barrick has been hampered by different operations in different locations. This is a really big company with a sprawling portfolio. And at the same time, we've seen that some of the most successful gold mining companies in the industry are companies that have a more concentrated geography. So Agnico Eagle, for example, has performed exceptionally well over the past couple of years, and all their assets are essentially in Quebec. So we've seen this trend in the gold industry where companies are looking to sort of consolidate regionally, and it looks like that's what Barrick is trying to do now.
Thank you very much, Jacob. Always great hearing from you. Jacob Lawrence of Bloomberg there. After the break, we're going to switch to uranium, another of our great loves. Denison Mines just announced an acquisition, and we heard from the CEO. Denison Mines is working on a gigantic potential uranium mine in Saskatchewan and just bought a company that's right next door. We heard earlier from David Cates, CEO of Denison.
Our company is laser focused on our development project, the Phoenix project on our Wheeler River property. And we're very close to being permitted federally and provincially, and expect to be making an investment decision in the beginning of 2026, which will make us one of Canada's newest mines and certainly the newest uranium mine in over a decade. But with that on the horizon, our job is to look beyond the short term and into the long term. And so we do have a focus on our other development assets and exploration for the long run. And so this transaction with Sky Harbor is a really unique partnership. We've been invested in Sky Harbor for many years. And what we're doing in this transaction is we're purchasing an interest in a number of newly created joint ventures with Sky Harbor that will come out of the Russell Lake property that Sky Harbor just recently consolidated full ownership in from Rio Tinto. And now we'll have 4 different joint ventures with Sky Harbor where we're purchasing an initial interest in these different joint ventures, and then have an option to deploy a significant amount of exploration spending on particular 2 of them to be able to increase our interest up to 70% on those 2 claims. So the notable part here is that Russell Lake and the joint ventures that are falling out of this project are adjacent to our flagship Wheeler River property, where we are on the cusp again of having our permits in hand to execute on the Phoenix project.
And with those 4 different parts and 4 different percent, why the different percentages ownership for each one?
Yeah, great question. Russell Lake is a very large land package that Sky Harbor has invested in over the last few years. It's exceptionally large, and by splitting it up into 4 different JVs, we really believe that we can maximize the attention that the projects and the targets need. You'll have Sky Harbor operating on multiple of these joint ventures. We'll be participating, and then you'll have Denison operating on particularly the Wheeler North joint venture. And so it's really a matter of putting both teams to work and maximizing our joint exposure to discovery. These uranium deposits in Saskatchewan are incredibly rich, but because of that, they're also very difficult to find. High grades come with small footprints. And so we really do like the idea maximizing the attention that each part of this really large land package requires and deserves.
And just looking for a bigger picture at the moment, how is the uranium sector looking right now? It must be fairly optimistic for you.
Well, I've been in this industry now approaching 20 years, and we've obviously seen ups and some prolonged downs. I can tell you that right now the sentiment is as positive as I've ever seen. You don't have to look very far to see excellent positive news developments for nuclear energy deployment globally. It's not just about clean energy or the energy transition. It's often about energy sovereignty, taking a reliance off nations that are maybe not your preferred partners. And so we do see an incredibly positive story brewing on the demand side. And of course, in economics, we also have to think about the supply side. And owing to that very long and difficult period of time that we had with very low prices, where we saw the best mines in the world have to shut down over the last decade, I can tell you that supply is also in a vulnerable place. And many projects that have tried to restart have struggled. And there are very few excellent top-tier projects in the pipeline. We of course, promote our Phoenix project because it does have the potential to be one of the lowest-cost uranium mines in the world, but it is an outlier. The majority of new supply, much of which will be required to balance the market in the long run, is in jurisdictions where grades are low, costs are high, and risk is high. And so, the ability for supply to meet that demand that's growing is actually going to be quite challenging.
David Cates, the boss of Denison Mining. We've got a final chat for you here. Vegemite is a beloved commodity for Australians. A prisoner in that country, he's actually a convicted murderer, 54-year-old Andre McKechnie, is suing the state government, saying that he's being denied Vegemite and it violates his human rights because he should be allowed to, quote, enjoy his culture as an Australian. He murdered a Queensland property developer in 1994. Apparently, Vegemite has been banned in all of the prisons in Victoria State, partly because inmates smeared the stuff on drug packages to try to deter the sniffer dogs. Maybe they found it repellent. But also there were claims that inmates could use it because it's made from yeast to cook up prison hooch, moonlight. Australia, of course, it's an icon there. It has an estimated 80% of households with a jar in their cupboards. A decade ago, there was a claim that remote Australian Indigenous communities were using Vegemite to brew alcohol. But the then US owner said, nope, you can't actually do it. The yeast is dead and Vegemite cannot be fermented into alcohol. I thought I should share that story with you. Thanks very much for watching Commodities. The close is up next.